I'm Nicholas Bornoz of Capital Inc., and I would like to welcome you all to our 22nd Closed-End Funds and Global ETFs Forum. This forum has been going on for quite a long time. This year, we're holding it digitally, and we are giving the opportunity to investors and interested parties from all over the place to join us in what is expected to be a great discussion. I'd like to thank the sponsors, the participants, the New York Stock Exchange, and I will turn it over to Mariana Fariña. Mariana, and like everybody else, has been with this event for so long. Mariana, please take over and introduce our panelists. As you all know, Mariana is a research director for closed-end funds and ETFs and passive products at the Wells Fargo Investment Institute. The floor is yours. And again, thank you to everybody for joining us today.
Thank you very much, Nicholas. And first of all, thanks to you and to your entire team for having this 22nd annual Capital Link conference. It is a wonderful event for all of us who have been doing closed-end funds for a long time to just get together, exchange ideas, see old friends. So thank you very much for that. We're starting with an absolutely fabulous panel of individuals who have known and done closed-end funds from many perspectives for many, many years. And what I will ask is to each of you, please introduce yourself very briefly, and then we'll dive into the topics that we have prepared. And maybe in alphabetical order. How about Bob? How about if you go first?
Thanks, Mariana. Pleasure being here. And thanks to Nicholas and Capital Link for arranging this. My name is Bob Bush. I'm a Senior Vice President. I'm Director of Closed-End Fund Products at Calamos Investments.
Thank you, Bob. How about Stephen? And I may call him Nuveen Stephen because we have two Stephens.
Thank you, Mariana. Thank you, Nicholas. And thank you to Capital Link. Happy to be here. My name is Stephen Davis. I'm a Closed-End Fund Product Specialist at Nuveen. That means that my role here is really to support our internal sales teams in their conversations with clients. And I act really as a sort of go-to resource in the secondary market for anything and everything related to closed-end funds.
Thank you very much. And how about next, BlackRock, Stephen?
Hi, everyone. Thanks for having me join today. Again, Stephen Minar. At BlackRock, I oversee the closed-end fund product here. What that means is we work on product development, product strategy, supporting our products in the secondary market. I've also been in this industry for a little over 15 years now, having seen it from both the research angle on the investment banking side, launching new products, and now again, managing the product here at BlackRock.
Great. Thank you, Stephen. And last but certainly not least, Mike Taggart.
Thanks, Mariana. Thanks, Nicholas, and everybody at Capital Link. I'm Mike Taggart. I am a closed-end fund specialist at Aberdeen. My role is very similar to Stephen Davis' role at Nuveen, and I have a bit of a technical glitch where everything I do and say is delayed, so I apologize for that.
That's okay. We can hear you loud and clear, so thank you, Mike. And with that, let's dive into kind of our agenda. And I've sorted this agenda very intentionally because I think talking about topic 1 will help us understand topic 2, and that will help us understand topic 3 and 4. So the 4 topics that we'll be covering is, first of all, especially very important, leverage and the implications on distributions. And if you think this is an interesting panel, just please make sure that you listen to the next panel, which is all about leverage. That will be very interesting. Next, number 2 is we have to talk about premium discounts with closed-end funds, and that is extremely noteworthy and important these days. You'll see, and we'll tell you why. And number three, we'll talk a little bit about IPOs. Maybe there's not too much to say about that these days, but I think it's something to discuss briefly. And number four is corporate actions. Seems like corporate actions have increased, so we'll talk about that. So let's just start with a discussion on leverage and the implication of that in distributions. And what I've told our very esteemed panelists is, let's just have this as a conversation, fun conversation. And I know every one of us has been doing closed-end funds for many, many years and even decades. So I know we're going to have a really interesting and insightful conversation. So on leverage and distributions, Stephen Davis, can you kind of start with that?
Absolutely, yeah, I'd be happy to. So I think, as you alluded to there, Mariana, I think perhaps the dominant theme in the closed-end fund world in the last 12 to 18 months has been rising leverage costs and their impact on closed-end fund distributions. We witnessed significant hikes by the Fed in 22 and so far this year. And that's had the effect of increasing borrowing costs for, many closed-end funds that utilize leverage. And although we've seen yields increase, and many investment teams have been able to book higher yields within their portfolios, often the case that hasn't been enough to outweigh higher leverage costs. And the impact has been that earnings per share have dwindled in many levered closed-end funds. And that's meant that closed-end funds have had to reduce their distributions to bring those in line with earnings. And we've seen that across many strategies, not all strategies, but we've seen that across many asset classes. And that's, of course, reduced distribution rates and somewhat made made closed-end funds less appealing. How has that manifested itself? Well, we've seen discounts widen across the board, and I'm sure we'll talk about that extensively in this conversation. But really, that has been a chief concern of advisors, and I've handled many calls on those issues to do with leverage, how we utilize leverage, how we try and minimize costs of leverage, and I think closed-end funds have really struggled with leverage. I think we're coming to the end of the problems with leverage to a certain extent. Our view is that that the significant distribution cuts that were made by many sponsors last year and early this year are possibly behind us. That said, we think rates remain elevated and they continue to be a risk, but I think the risk of larger distribution cuts has somewhat dissipated. So I'll just sum up by saying leverage has been an issue for closed-end funds in the last 12 to 18 months, as we know. Generally speaking, leverage has, and certainly before COVID, leverage has been highly successful and allowed many funds to increase their income and total return. But it's certainly been a negative impact this last 12 to 18 months.
Thank you, Stephen. Anybody else that would like to add anything, kind of what you've been seeing on your own funds?
Sure, Mariana, I'll jump in here real quick. I think it's important to remember that, when it comes to leverage in these products, it's really a structural component for these funds. It's not something that we're necessarily taking off or putting back on, depending on the market environment. Again, investors are coming to closed-end funds because they are closed in nature, and that gives a benefit to the fund in the fact that it can use leverage, which is not something that open-end funds or ETFs can use. And so historically, closed-end funds, to Stephen's point, have paid materially higher distribution rates, and the way that they're able to do that is through the use of leverage. And so Again, while that maybe has impacted performance here in the short term, over the long term, we have seen outperformance due to that use of leverage. A few other things that I think investors should just be cognizant of when it comes to muni leverage. Pay attention to also the mix between preferreds and what we call tender option bonds, because the pricing of those the cost of that leverage can differ. And when you look at that, also you want to be cognizant of what the base rate is. And so most municipal leverage, for instance, uses a rate called CEFs. That has been fairly volatile over the last year, given the uncertainty of the Fed interest rate increases. There's another rate called SOFR, which was a replacement for LIBOR. For leverage using that form of base rate has actually been more expensive than the CEF base. And so again, it's important to keep those those nuances in mind. When it comes to leverage, though, I think it's not all a negative story right now. One area I'd focus on in the market is senior loan funds. Now, again, you want to be comfortable with the credits here. These tend to be higher, high yield credits. But what we actually see is that those funds have been increasing distributions because, again, they benefit from the fact that short rates are rising. And one thing just to keep in mind there is that when the Fed increases rates, yes, your borrowing cost goes up immediately. Over time, though, your income in those portfolios will also go up as those loans reset to those higher rates. And so, again, you're seeing senior loan funds that are paying double-digit yields right now and earning those yields.
Great. Thank you, Stephen. Yeah, Bob, I'll get to you just very briefly. You talked about that the portfolios are also adjusting. And the way sometimes I explain it is that the increase in the cost of borrowing hits a little bit like a speedboat. And the increase in the book yield of the portfolio is a little bit more like the Titanic. So good things are coming, but it just takes a little bit longer for that benefit to be seen. Bob, you wanted to say something?
Hi, I'm sorry to step on Stephen, but I just wanted to sort of elaborate on a point that he was making, is that, we've seen increased leverage costs this year, obviously, as the bond market has deteriorated, but it's really about what the reinvestment rate is relative to what the leverage costs are. So sure, you may see your leverage costs going up 300, 400, 500 basis points, but if your reinvestment rate is earning a positive spread, then leverage is indeed positive to the overall portfolio. So this year, and generally speaking, you've seen equities, the S&P's up roughly 10% year to date. Bonds may be up half of that. So maybe the bonds are struggling, the longer duration bonds are struggling with respect to their leverage costs, not so much the floaters, which Stephen's alluding to, because those obviously increase their distributions, as rates go up. But equities on a year-to-date basis have held in there pretty well. And arguably, if you're earning 10% NAV on an equity fund, you're probably surpassing your leverage costs at that point. So the investor should realize that you shouldn't paint all of this with one brush. Bonds and stocks often act differently, such has been the case this year. And what is the leverage impact on that particular fund, right? Rising leverage costs, not always all that bad, depending upon what your reinvestment rate is. So to the investor, roll up your sleeves, look at what's in the assets of the portfolio. How are those doing? How do you expect those to be doing relative to what their leverage costs are? And make your investment decisions based on that.
Great points, Bob. Mike, any additional comments?
I mean, I just would pick up on what Stephen Minar said about it, leverage being a structural component of most closed-end funds, right? And how it's for longer term investors, and over the long term, leverage has benefited most funds. And, shareholders obviously are concerned about that spread that Bob just mentioned. They're concerned about the increased volatility that leverage can bring. But, the portfolio managers are investing for the long term, and to change leverage to something that's tactical that you put on and put off, right? I mean, that's market timing. And, really nobody in the industry does that, right? So that would be to use it tactically would just be another layer kind of uncertainty and potential volatility.
Great.
Yeah, I would just add one thing real quick, Mariana, if we have time. I think we should be aware that leverage in some portfolios can add to the duration of that portfolio as well. And I think for investors that are looking at closed-end funds and want to take on some duration risk, closed-end funds are can be viewed as quite attractive. They have longer duration because of that leverage. And to Mike's point, portfolio accruals are increasing with high yields to the extent that PMs can rebook high yields in a closed-end fund structure. If and when we see rates move lower, we're going to have a widening of the leverage spread, which is going to be more accretive to the NAV and can potentially be, a nice tailwind for closed-end funds.
Great. Thank you very much. And how about if we move on to kind of our second topic? We kind of touched on it, and that's premium discounts. How the closed-end funds are trading relative to their net asset values, and we are at a very, very interesting point right now. So, BlackRock, Stephen Minar, can you maybe start the conversation about where are current discounts, where have they been in the last year, maybe historically, when have we seen these kinds of very, very wide levels of discounts, and reasons why we've gotten there. And maybe you don't need to answer all of that, but those are some of the points that I think I would like to touch on.
Happy to, Mariana. And before we get into the specifics of today, I do think it's just helpful taking a step back and understanding, that one, discounts are a component of closed-end funds. They have, closed-end funds have historically traded on average at a discount. And so I think it's important to, keep this in context and really focus on kind of what are the drivers of, changes in discounts. So, Stephen Davis mentioned up front that we've been battling higher interest rates. This has been the fastest increase in the Fed funds rate in over 4 decades, right? So clearly not normal times. And the impact of the leverage costs, rising leverage costs, and the impact on both the performance and also the impact on the distribution rates of these funds has clearly been a negative for the industry overall. As Bob pointed out, right, I think you do have to look under the hood. It's not necessarily every single category that has been hurt by this, by this dynamic. But in general, we are seeing closed-end funds trading at wider discounts relative to where they have historically. I think you also have to be cognizant of the risk appetite of investors today, right? You can invest at the short end of the curve or even in money market instruments and earn a 5% yield. That's something that you just didn't have only going back 18 months ago. And so again, I think there's a lot of money on the sidelines right now that is just hiding out on the short end or in money market accounts, flipping that attractive yield and waiting for a better entry point. And so, those two factors are really driving what we would consider to be negative market sentiment. And that's been the primary driver of premiums and discounts over time. You don't have to look back very far. You can look back to 2021, where most closed-end funds were actually trading at premiums. And so again, these things fluctuate and they can change fairly quickly. Beyond just the market, sentiment angle of this, I think you also have to look at it, again, at the individual category level. So, how do funds trade relative to their peers? I think these aren't really surprising outcomes, but I think it's helpful just to note that, performance tends to be the strongest, driver of how funds trade relative to their peers over time. We also tend to see distributions, given these are income-focused vehicles, particularly for municipals. If you were to simply just rank sort, the muni universe based on NAV yield, I think you'd see a pretty high correlation to where they trade in terms of a premium discount relative to their peers. And then the last thing, and we'll get into this topic a little bit more later in the conversation, is around liquidity. And so, things like mergers can help increase liquidity for these funds and bring in new buyers into the market, given the fact that, a lot of these funds tend to be smaller in nature, don't trade a lot. So the more liquidity you can bring to the market, it becomes more attractive to more investors. And so, again, just thinking about historically over time, we've definitely seen these ebbs and flows in terms of premiums and discounts. What I've noticed, at least in the last 10 plus years, basically since the global financial crisis, is that we're actually seeing greater volatility in these premiums and discounts. And so again, while we're at historic lows today, that can quickly swing back, to narrower discounts, narrower than the average, potentially premiums. And so I think that's the important thing here is that for investors, you really have to be a long-term investor in these funds. No one's an expert at timing markets, and so you're going to benefit from the advantages that the structure offers to you. Namely things like leverage or accessing less liquid investments and not, being exposed to daily flows. In order to benefit from that, you need to be an investor through all those ebbs and flows. So for investors that are looking at the market today, I think, you want to, one useful tool that I like to use is something called the Z-score or Z-stat. Basically what it tells you is that, where is the current discount trading relative to where it historically has been, and adjusting for that volatility of the discount over time. I just quickly pulled from CEF Connect, which is a great tool for anyone that's listening and doesn't use it today. It's a great tool for closed-end funds. There's over 200 funds that are trading at a Z-score of more than -1, meaning that their current discount is greater than 1 standard deviation away from where it has historically traded. There are a lot of funds that are above 2 on that as well. And so, again, I think there are a ton of interesting opportunities out there, particularly in this time period of what we consider to be tax loss selling season, which tends to be a more negative part of the year for the market. But we're quickly moving into the more positive part of the season, where we see that January effect and tend to see discounts narrow in the new year.
Thank you, Stephen. Anybody else would like to comment?
Yeah, Mariana, I think when you think in terms of where we've been over the last, call it 12, 18 months, I mean, it's almost been a perfect storm against closed-end funds as far as their pricing is concerned. And notwithstanding their NAV performances, financial markets have been challenged, but you've had a rising interest rate environment, increase in leverage costs. You've had a weak bond market. You've had a weak stock market last year. Nothing performed well. On top of that, you've had a primary market which has virtually disappeared over the last 12 months. I do believe a primary market does support the secondary market because you're out there discussing closed-end funds and the opportunities, and it just maintains the awareness of the product. So it's kind of been the worst of all worlds, if you will. The Z-scores have gotten a lot wider, as Stephen has pointed out. The discounts have gotten wider. We were on average roughly about an 8% last year. At the end of last year, now we're pushing upwards of 11%. So there's clearly opportunities there. And as we all know, this is primarily a retail product. Retail tends to source closed-end funds for cash, for capital requirements relative to maybe other stocks they own or other mutual funds. So it's kind of been the worst of all worlds. That said, this might be the time where value does make a difference. If you believe that we're in an interest rate environment that is going to abate, that the Fed is going to sort of let up, if you will, depending upon where the inflation is, that obviously is juxtaposition with where corporate earnings are. But I think we're likely to be in a better market going forward than maybe where we've been. There's certainly some great opportunities out there. And again, one of the things that I've always discussed about with our clients is that if you understand the closed-end fund space, you clearly have a leg up on many other advisors that may not be as conversant, because there's oftentimes some fantastic opportunities out there in the closed-end fund space. And that's really what we try to provide here for our clients, whether it be on the asset management side or certainly on the advisory side, is to highlight these opportunities if and when they are available. Because candidly, it's the top-notch advisors, it's the top-notch asset managers that are involved in the space. So you're getting quality money managers in this, okay? So have a little trust in them. And when these valuations become compelling, which they really are today in some aspects, may be worthy taking a look at a lot of these products.
I totally agree with you, Bob. Most of the managers are really top-notch. And in other vehicles, they may charge a lot more than in closed-end funds. And then on top of that, if you get these amazing discounts, they are bargains. Mike,
Yeah,
it sounds like you would like, or Stephen.
Oh, I can.
Yeah, go for it, Mike.
Okay. So I mean, I've long said, the discounts on closed-end funds are features of closed-end funds. Stephen Minar mentioned, that again, that they're structural. And, in my experience, the most successful closed-end fund advisors, to pick up on what Bob was saying, it's the worst. It's the worst of all worlds, right? In terms of discounts, the best closed-end fund investors tend to be contrarian investors. So, when they hear that it's the worst of all worlds, that's the time, to get in. And, conversely, a lot of interactions, these days with investors, closed-end fund investors, they're looking to sell with the wider discounts, right? And everybody has their own reason. Maybe it's tax loss selling, maybe they're just kind of tired of dealing with the widening discounts. But really, again, the most successful investors in closed-end fund world that I've ever come across are the ones that are willing to be buying when the discounts are wide, and especially this wide. And again, as Steve Minar pointed out, it wasn't that long ago. At the end of 2021, most closed-end funds were trading at premiums. I think the average discount was like 3%, right? So again, it's cyclical. So,
Stephen, you wanted to say something?
Yeah, and I'll keep it super brief. I think we put out a paper recently looking at current discounts versus short and long-term averages by asset class, and we know that across almost all asset classes, discounts look particularly wide, relative to those means, particularly in municipals. Actually, if you look at where the Z scores and where the current discounts of munis across all credits really are stretched, where are they? They're in the municipal sector. But I think Stephen is absolutely right. The Z score is a great tool to use. We just want to make sure that we understand the asset class, we understand our risk tolerances, we understand leverage, but we view Z scores as an excellent tool to screen funds for sort of further research and making sure those funds fit in with our other investment objectives. And when it comes to a Z score, that the more negative, the better, kind of thing, conversely.
Thanks. Thank you, Stephen, for mentioning the report or the document that you've put out. Do you mind explaining how individuals could access that? And right after that, I know BlackRock, Stephen, I know that you've put out a document on premium discounts of closed-end funds. Maybe you could go right after that, telling where investors can find the BlackRock document.
Yeah, absolutely. I'll be real quick. Yeah, we published an article discovering value in discounted closed-end funds. It's available on our website, and we can happy to chat with any advisor after this call and go through that white paper. So it's available on the website. We looked at various asset classes, and we looked at we examined how to use these Z scores to really understand what they mean and avoid value traps and so on and so forth. But I'll hand over to Stephen as well.
Yes, and thank you, Mariana, for that call out. So on BlackRock.com, if you're using the Advisor Center, you would go under the Products tab, Products, and then Closed-End Funds, and scroll down. The paper is called Understanding Closed-End Fund Premiums and Discounts, and this is based on very in-depth research by our independent risk and quantitative analysis group. Very high-level document. We're also looking into maybe publishing a white paper that gives more detail on how we arrived at these conclusions. One last thing I just want to bring up on this topic, because I feel like it's worth mentioning, I think everyone on this panel has a product with this type of structure, which is the term structure. And so a lot of funds that, every fund basically that's been brought to market since 2019 has had a term feature to it. And so I think that's something that goes unnoticed to a lot of investors. And most of these were 12-year terms, so they're far off in the distance. But you again now some of these funds are 3-4 years seasoned, so you're getting closer to those terms. And one particular example I would use is like our BSTZ, which is a technology fund trading at a 24% discount. and it's going to mature in 2031. So you have basically another 8 plus a little over 8 years, and you're going to realize 3% just from the discount alone every year in that fund. Another thing that I just want to draw people's attention to is that if you do your research, you can actually find even more discounted funds, and what I mean by that is BSTZ, again, just using it as an example, does have a private allocation in it, and I think that's one of the reasons that it's actually trading at a wider discount today, is that there might be less confidence that NAV is truly reflective of the values of those privates, which aren't priced on a daily basis like the public equities that we hold. But I would argue that we're actually, being very conservative in valuing those positions. We put out a quarterly commentary with all those individual positions, with where we purchased them and where they are marked today. And in the hopes that we could give more confidence to the market that those NAVs are more reflective, or even potentially penalizing us more than what they're at, where those securities would be priced if they were to come to market today. So worthwhile, again, doing a little bit more digging on in terms of that term feature, which again is another filter that you can use on CEF Connect, and then looking into the underlying portfolios for those value opportunities.
Great points, Stephen. Thank you for bringing that up. Anything else before we move on to the next third topic? Okay. The third one is, and Bob, you mentioned the primary market, so the IPOs on closed-end funds. Bob, can you tell us what's going on there, if anything?
In short, nothing. We haven't had an offering done since last year in October, when BlackRock came out with a muni deal. Pretty much been shut since then. Again, the reasons are you're having widening discounts, increased leverage costs, just poor performance across the board because of financial assets. Retail sort of, I guess you're having a sell-off because they're seeking closed-end funds for cash purposes. So it's kind of an open slate right now. I think if I had to guess, and my guess is as good as anybody else's on this panel, or perhaps anywhere else, is that what you want to do, the first rule in putting a closed-end fund together, and I did a number of these in my prior life, is that you want to make sure there's a raison d'etre for it, not only from the investment perspective, but also you want to be able to look at an area where they're trading well, arguably at premiums or at least close to par, and there just aren't a lot of those out there. But the ones that get as close to that as possible are more of on the fixed income side, more of the ones that tend to have lower durations. For example, we manage a number of convertible funds. Right now, we have 2 of our funds trading at premiums, which is a bit unusual in the closed-end fund space. We have one that's actually trading right at par. So, but in the convertibles, the average on those is roughly 5% discount. So that might be something that's something you might want to entertain. Global income funds right now are doing relatively well, again, compared to other products. They seem to be trading roughly flat. Again, I think on the credit side, maybe in the senior loan side, you're going to see elevated yields there. And again, if you get a product where you're not going to be penalized for leverage, in other words, where inherently the leverage that you're paying is going to be lower than what you're going to earn on the return or on the cash flow, and that's something I think that you have an option to go out in the market with. But you have to be cognizant of all those factors right now. So the window is very, very narrow. And there's a lot of things that have to happen in the closed-end fund space, Mariana, as you well know, to sort of get it re-energized. And it may be a while. I mean, it's sort of like the child in the nursery rhyme. When they're good, they're very, very good, which we saw, over the last couple of years. But when they're bad, they're horrid. It's kind of hard right now.
And we've gone through these periods where there's no IPOs, and then there are some IPOs again. Any other comments from anybody else in the primary market? Okay, we'll keep it short because not much going on there. The next topic on corporate actions, I think there is a lot of action going on there. So Mike, can you kind of lead us with this one topic?
Yeah, sure. Thanks, Mariana. And being cognizant of, I'll try to speak quickly. We're coming up on the end. just look, if you were to look back historically on the history of closed-end funds back to the 90s, right? When you have these periods where the IPO market's dormant, you often have other sorts of activity, right? So you've often had mergers of funds, consolidations, product line rationalizations, things that Aberdeen has been doing lately, which is acquiring one fund firm acquiring funds from another fund firm, and that sort of thing. So we have seen quite a bit of that, especially in terms of consolidation. Both Nuveen and I think BlackRock both have done that extensively over the last few years. And I know when I was at Nuveen, we were doing that 10 years ago already. So and they've done it since the 90s. So at Aberdeen, we acquired earlier this year. We acquired the Delaware closed-end funds. Last Friday night, we acquired Tekla Capital Management and their 4 closed-end funds. And it was announced that we will be acquiring pending shareholder approval for First Trust closed-end funds. Right, there are other firms doing similar things. So, again, putting that into historical context, this isn't anything new. The benefits of having larger funds, are the increased liquidity, which Steve Minar mentioned earlier. You also have larger economies of scale, which can drive down total expense ratios, and all sorts of other benefits that can come out of that. So.
Great. Thank you very much, Mike. Now you mentioned mergers, and that's probably the most common corporate action that we've seen, and Nuveen and BlackRock have done a number of them. So any of the two would like to add here?
Yeah, I can jump in real quick. I know we're coming up on time, but I would just say, to Mike's point, this is something we do and have done quite a bit this year as part of really an ongoing process to streamline the fund lineup and create economies of scale and all the benefits that come with them that Mike mentioned. We've merged 2 state municipal funds into a larger national fund. We've merged 3 senior loan funds into an existing senior loan fund, JFR, thereby creating the largest senior loan closed-end fund in the market. And we're doing a similar thing with the preferred space. So for us, it's been an ongoing process, and I'm sure Stephen will sort of echo that. We see the benefits to shareholders, the target share, for the target funds and the acquiring fund, and where strategies have a significant level of overlap and can be consolidated without significant alterations of the strategy. I think it's beneficial for all shareholders.
And I would generally agree with everything that Stephen just said. Again, this is an effort that we have that's been ongoing. I counted earlier, we've done 48 mergers, not individual mergers, but of funds being merged away. So, consolidating the lineup, making it easier for investors to, focus on our lineup, right? If you have multiple of the same type of strategy, there's no need for multiple funds. You can just merge them together, realize those economies of scale, save investors money, potentially increase your earnings, etc. One of the things I just wanted to highlight is the challenges with these things, which again are beneficial to shareholders, is that it's difficult to sometimes get the vote. And so it's really critical that we get our clients and our shareholders to vote their shares. And one of the things that I've recently learned about is a Broadridge app that's called Proxy Vote. I suggest everyone download it. I have it on my phone. It aggregates all of your proxy votes across your holdings, regardless of where they're held. If it's in the Broadridge system, it'll pick it up, and it's very simple. It took me about a minute to sign up for it, and again, it's just a very easy way to vote your shares when there is a corporate action.
I'm so glad that you brought that up, Stephen. I want to finish because I see Nicholas's face, so that's we need to finish. Just vote and vote promptly. Don't wait to prompt, because it gets more expensive, and the shareholders are the ones who pay for that. So vote promptly. That's what I was going to say. And thank you so much to all the 4 very esteemed and wonderful panelists. This was great. I hope everybody else enjoyed it as much as I did. Thank you very much, and passing off to you, Nicholas.
Thanks, Mariana.
Well, I want to thank you very much, Mariana. Thank you for moderating. Bob, Stephen, and Mike. I really appreciate enormously on behalf of the whole Capital Link team that you joined us today. This has been a great discussion as expected, very well attended, and thank you very much. By the way, this will be available as an archive to be accessed upon demand. So I'm sure a lot more people are going to come back and listen to your insight. Thank you very, very much.